today's session, Intermodal Market Trends and Statistics, 2017 Mid-Year Update. I'm Hal Pollard. Really pleased today to welcome two terrific presenters from TTX Company, Edgar Gutierrez, who is the Director of Market Development at TTX, as well as Peter Wolf, who is also a Director of Market Development at TTX. Two great guys who know a ton about what's going on and are going to walk us through the update on where we are numbers-wise today. Just to give you a little overview of what to expect, we're going to take a look at the current economic conditions and kind of see where we are right now. Take a look at the latest IANA numbers, and then have a look at the international and domestic intermodal numbers and see where they are, and then open it up for questions. That should give you a little roadmap of where we're going. If you want to get access to the information that Peter and Edgar are going to be talking from today, that is drawn from both the IMTS report, the Intermodal Market Trends and Statistics report, as well as the ETSO database, which is also available. So you can get the report as a member benefit, the IMTS, but you can also go much deeper into the details of where these numbers come from the ETSO database. There's more information about that at the end of the webinar. So without any further ado, I am going to kick it over to Edgar and Peter and have them share their information with us.
All right, thanks, Hal. Thanks for that very nice introduction. And we'll jump into the economic slides. We have about 4 of them, and talk about what we see going on right now. There we go. So the economic overview, when I look at all these bullet points, what jumps out at me with all this stuff is it just seems that this year feels a lot like last year, which isn't bad. GDP is growing about 2.1, 2.2% in that range, a little bit better than last year. But things really, I think, feel a lot like last year with a couple of exceptions, which we'll talk about in a couple of slides down the way. So one thing we want to talk about is low energy prices. They seem to have been sticking around for a while. They're going back almost 2 years, fairly low rates. When I think about it, way back when I was a little kid, not that I can remember this, but I went back, I looked at the data, late 60s, gas was selling 40 cents a gallon, 50 cents a gallon, and I don't think anybody then thought that gasoline was expensive. And so if you took that 40, 50 cent gallon of gas and you applied inflation to it, you get to a gallon of gas that costs about $2.33 today. And when you look at the actual price, the national average today for a gallon of gas was $2.35. So when you think about it, gas is as cheap today as it was in the mid to late 60s, which I think I'm surprised at all that. I never would have expected that given all we go through with gasoline prices. And they've been fairly steady. Now, who knows, if there's going to be some geopolitical event that could cause a big spike in gas prices. But for the time being and for the foreseeable future, we at TTX think gas prices are going to be fairly stable and fairly moderate. Although when I say that, if I could really forecast gasoline prices or fuel prices, I would buy everybody listening on the call their own private island in the South Pacific, because trying to predict gas prices is not really a good form of, I won't be lucky with it, let's just say that. I won't be accurate, but hopefully that's what's going to happen, and that's our prediction. So the next slide, if I could. We watched the strength of the dollar. One of the big drivers of the imports and the rail volume of that is really going to be the strength of the dollar. The stronger the dollar, the lower the price appears to be of the imports, but at the same time that hurts exports, and as the dollar weakens, exports will rise and imports will fall. We think maybe beginning middle of next year, other governments may start to increase their interest rates, which may make the U.S. dollar slip a little bit and make that a little weaker. We'll sort of see how that goes. Stay tuned for future seminars. But for this year and for last year, the dollar is pretty strong, and that's going to explain some of the numbers that we see with decent import and intermodal growth. And then the last slide on imports, or on the economy rather, is just a little table with a lot of numbers on it, trying to summarize key economic and intermodal indicators. Again, as I talked about it last year, looking at the top line, GDP was 1.6. This year it's we think about 2.1. So feels a little better than last year, but about the same thing. Two major differences from last year. If you look at the investment line in 2016, investment fell 0.5%. This year, we're forecasting it to grow 4.1%. What is investment? Investment is when corporations buy equipment, build structures, could also be residential structures. Corporations build up inventories, just general levels of business activity. That would be considered an investment. Likewise, another strong leading economic indicator is industrial production. Again, in 2016, it declined 1.2%. This year, it looks like it's growing about 1.7. So what is industrial production? It consists of three components: manufacturing, electrical production, and extraction. And if you were to break the data apart, you would see that manufacturing and electrical production are about the same this year as last year. What's showing a lot of growth is extraction or fracking, oil production, all of that. So when oil prices plummeted a year and a half ago, oil manufacturing fell, that drew down industrial production. Now it's come back a little bit, and that's helping top-line GDP grow. And then the last line I want you to look at is Canadian GDP, whereas in 2015 it's growing 1.5%. This year it's projected to grow nearly double that, and that growth will be reflected in some of the numbers that we're going to talk about coming up. Okay, so let's talk about the latest and greatest IANA numbers. I'll turn it over to Edgar for a few slides.
Thank you, Peter. Good afternoon, everyone. So we put together a little summary of how 2017 has looked so far for the intermodal, and we've had a pretty decent first half. You see the numbers in there, and we just actually got the July numbers that I wanted to share with you briefly here. International doing very good for July at 8.3%. Domestic containers at 4.6% for the month of July again, and trailer with a surprising 6.1% growth for this month overall. Once again, very first good half for intermodal. The next slide is basically a repeat of the previous slide that basically shows the actual volumes, and that's what you could see that domestic versus international is about 50-50 split.
And then breaking down the data a little bit more, we have the next slide shows loadings by region. And you can see it's fairly consistent with the overall GDP. So U.S. GDP growing in the 2% range. Most of the regions are growing something along those lines, with the exception of Canada. And as I mentioned, there was decent growth in Canada, which was driven mostly by oil production in Alberta. So a year and a half ago, oil production really came to a crashing halt in Alberta, plus there was some pretty nasty wildfires that drew down the local GDP. So I think Alberta GDP declined 8% in 2016. So now it's come back, and you can see that the data shows Eastern Canada is growing 9%, Western Canada is growing 10%, all really related with product moving in and out of Alberta mostly, as well as some other places in Canada. We'll talk about the top growth lanes, and again, just kind of repeating this theme of strong growth in Canada is really driving a lot of the key lanes. So it shouldn't come as any surprise, right? Western Canada to Eastern Canada, Eastern Canada to Western Canada, and we're going to have the second line, intra-Western Canada, with 11% growth. That's really from imports coming into Vancouver and Prince Rupert going to Alberta. That's considered the intra-Canadian region for the IANA data. I'll let Edgar talk about the bad news.
Yeah, on the other hand, we have the largest declines, and when we break them out by corridor, we identified that, the southeast to Midwest, basically it's a decline on both domestic and intermodal. And intra-Mexico, it is mainly because of international volumes are down for the year. The third largest one, south central to the Midwest, is because of ISO containers or international volumes down.
All right, so let's talk about international intermodal. We have a few slides to go through here, just to give you a term of art or to make sure we're all on the same page. So when we talk about international intermodal or IPI, inland points intact, ISO is moving inland, or marine containers. These would be the 20, 40, or 45-foot containers that discharge at a port and then route inland by rail. So they all have, it's a bunch of different names, all saying the same thing. So hopefully I'll speak consistently and just refer to it as IPI or International Intermodal. So that's the definition of it. I think everybody on the call has probably heard that before. But just looking at the data, what does it mean? And I think it means that the divergence has ended. And so my joke for the presentation is the divergence, which occurred last year, was a bad movie, was a horror movie, where last year imports into North America grew roughly 3.3%. International intermodal declined about the same rate. So it was a 6-point gap. And it's never really happened before. I mean, there were years where international intermodals declined, but that's when imports declined, right? So going back to 2008, 2009, that makes sense. Fewer imports coming in, fewer rail moves. But we've never really had a situation where imports were growing at a pretty decent rate and rail volumes were declining. But through the first half of this year, this seems to have ended. So when you look at U.S. and Canadian imports, they're up about 6.3%, and IPI, or International Intermodal, is up 4.3%. So this 6-point negative gap that we saw last year has closed to about 2 points. And 2-point gap is about where it's been for the last 5 or 6 years. So it seems like a normal first half anyway. But having said it's a normal first half, I think when you sort of tease the data apart, you can see that there's still some weakness in international intermodal at the PNW and PSW ports, but it's offset by growth in transloading. So if we look at the top line in Western Canada, imports grew close to 10%, IPI is growing about 11%, transloading is up about 6%, and total rail volume is up about 10%. So it's a nice balance. Imports up 10, total rail up 10, seems normal, seems about right. In the PNW, a little bit different story, but still balanced. You see imports growing 1.5%, international intermodal is up, that's down 1.1%, transload is up 6%, those net out to about a 1.6% gain, which is about consistent with the import volume growth. When you look at the PSW, it's a little bit different story. So PSW would be the ports of Long Beach and LA, imports up about 5%, IPI up, barely up 0.2%. Transload, on the other hand, up about 7%. That nets out to about 3.4% overall rail growth. So still a little bit of a gap there. And then total, you can see that imports are up at 6.3 that we talked about earlier. IPI is up 4.3, transload up 6. So net is about 5.5. So it's close, not a huge gap. And why do you have that gap at all, which would be the subject of the next slide, and that's going to be all-water share. And I think at our prior seminar, we talked about all-water share, but just so I have, to make it clear what TTX thinks of all-water share, these would be imports that originate in Eastern Asia, China, Japan, Vietnam, Malaysia, that geography, and have those containers discharged in a Canadian or a U.S. Eastern port. And then the way to read the slide is the 4 lines on the bottom where you have Northeast, Mid-Atlantic, Southeast, and Gulf. That represents the percent of the Eastern Asian imports that discharge in those regions. And if you add those 4 lines up, then you get total all-water share. And those 4 lines add up to about 33%. And that's the top green line. And you can see that all-water share has been climbing steadily since 2000. So one question that we may get is, how has the Panama Canal impacted all-water share? And to me, that's a difficult question to answer because all-water share has risen regardless of the depth or width of the Panama Canal at a fairly steady clip. It took a fairly big spike between 14 and 15, which was 18 months before the expanded Panama Canal became operational. So these were still relatively small ships, 5,000 TEU ships bringing cargo to the East Coast, and that was really driven by labor unrest on the West Coast, driving shippers to the East Coast. So again, if you add these 4 lines on the bottom, that gets to the total all-water share of about 33, 34%. And then to get to 100%, the remaining cargo lands on the U.S. West Coast. So roughly 2/3 of the freight from East Asia lands on the West Coast, and 1/3 lands on the East Coast. And the line that has grown the most of late is maybe a little bit hard to see, but it's the Gulf, which is the green line on the bottom. And there's been a fairly large gain in all-water service to Houston. So just a couple of slides to continue on transloads, and I think we've talked about transloading before as well. So what is transloading? Transloading is taking the cargo out of an international box and putting it into a 53-foot container and then sending it inland. And I want to be careful with these statistics for several reasons. One, nobody reports transloading. So I won't say we make it up. We never make anything up. No joke about that. But we do have to estimate where this comes from. And the way we estimate it, we look at the Piers data and we look at IANA data, and we take the ratio of the two. So if we look at the Piers data for the imports coming into the port of LA Long Beach, we get a total. We can look at the IANA data, and it has the number of ISO containers that route inland. That gives you the percentage that moves IPI. And then the data also shows the 53-foot containers routing inland from the PSW, and you simply get that ratio. And we make some assumptions that most of what is put in a 53-foot container in LA Long Beach is international freight, since not that much is made in the area. So again, it's the total number of 53-foot containers is the numerator, and then the denominator is the total number of imports coming in, and that simply gives you the ratio, or the yellow line. And then the red bar gives you the count in TEUs. So this is not 53s moving inland, it's the number of containers. If you were to divide that by 2.2, that would get you roughly the number of 53-foot containers that are moving inland. And you can see that this is, again, similar to all-water share. It's grown steadily for quite some time. And so why is that? When we talk to shippers, they say they really like transloading. It helps them with their logistics. The example would be, you're a retailer, and to get something, order something from Asia, you may have to order that 6 to 8 weeks in advance. And so when it lands on the coast, you can redeploy it to where you may need it if you transload it. If you don't transload it, the container is going to move intact to that original place where you thought you would need the cargo. So by transloading it, it gives you a real logistics advantage to get you the best place, the most likely place to make a sale. And maybe an example of this would be, since we're coming into the fall, although I hate to think about it, you know, it's going to snow at some point in the next 4 months in Chicago. You're going to bring in shovels, and you're going to stock the stores. But maybe Minneapolis has a more severe winter than you predict. If you keep your safety stock at some central location, say Southern California, you can ship that safety stock to Minneapolis, hopefully not Chicago. Hopefully we won't have the bad winter. But it allows you to move the cargo, your imported freight, much more readily. Another example, I was at a transload facility in the spring. So there's all kinds of seasonal merchandising coming in. On one side of the warehouse was 20 or 40-foot containers filled with barbecue utensils, barbecues from one manufacturer, lawn furniture in another container. And they were taking the freight out, and then they were mixing it up into 53-foot containers located on the other side of the warehouse, maybe 30 feet away. And they were just mixing up the freight, and now they could send the 53-foot containers directly to stores. And a store couldn't possibly sell a container load of only barbecues. But by mixing the freight up at a central location, now you have a container going to the store that's the barbecues, the barbecue utensils, the lawn furniture, all in one container. So it's helping redistribute the goods in a much easier way than doing it if it was originally packaged over somewhere in Europe. And then the same slide for the Pacific Northwest. Again, transloading has grown steadily over time. On a share basis, T&W transloading share is about 30%. On the Pacific Southwest, it's about 35%. So they're fairly close. And you can see it's grown over time. So I think that's all I wanted to say about transloading. Now I'll turn it over to Edgar. And I think this is a nice segue because all these transloads are really shows up as domestic volume on the rail. And overall, transloading is maybe 15, 16% of overall domestic volume. And in certain key lanes, it's a really large chunk of the volume that's in the lane. So now I'll turn over to Edgar, and we'll talk about domestic intermodal.
Thank you, Peter. Yeah, like Peter said, before we get into the slides to show numbers, just want to briefly remind you guys of the key drivers that move in domestic intermodal. And like he said, obviously transloading, it's a big part of it. But also, just like intermodal GDP and consumer spending, domestic production, the growth of containerizable goods, and domestic container fleet capacity. But more importantly, domestic intermodal is affected by truck equipment capacity, driver supply, fuel prices, as we discussed, and that's where I want to focus today's presentation, and we're going to dive in right now. So truck capacity, the changes in truck capacity are mainly driven by regulations, general driver shortage, no investments, and overall volume growth. This is a chart that it shows how trucking capacity is being tightened. We've talked to shippers and truck lines, and they expect a non-significant issue specifically with ELDs. Big companies have already been ELD compliant for quite some time. And however, we are already noticing signs of tight capacity in the trucking market. And the expectation is that it'll get tighter at the end of 2017, peaking in 2018, but will eventually move down and level to average levels by 2019. So what we hear from other agencies is that the overall impact, it's about 2.5% productivity in the entire trucking market. This is a very interesting slide that we like to borrow from our friends at Morgan Stanley, and it's basically an index that is showing how trucking capacity is tightening and how the market is behaving. So basically this slide shows you how truck capacity has crossed over the average, and I want to bring your attention to four main lines here. So when we look at all these colors, let's focus on the black line. The black line is the average of the last 10 years. And so far, the red line is 2017, and we've already crossed that. So basically, the way we read this chart is that the chart measures the incremental demand for trucking compared to the incremental supply. So when the red line that we're focusing on as 2017 is above prior years, it means that there's more freight demand relative to available capacity. If that line happened to be below, it will mean that there's less freight demand relative to capacity. So far, the red line is way above the blue line, which was last year's, that dark blue, and the green line, which is 2015, that we've already crossed at the end of June. So through August the 8th, this is when we got the latest update of this chart. In August, we are way above average and way above the last couple of years, and this is just an indicator that there's a possible tightness in demand caused by seasonality, regulations, and driver shortage. The other change that I said that affects capacity, truck capacity, is the no investment. And in 2017, we like this chart. We've taken this chart from Words Auto and our friends from FDR. Even though 2017 orders are above 2016 levels, companies don't seem to be buying at replacement. So they're not needing it. Sales, 2017 sales are under what it was last year, which I think this is an indicator that capacity will tighten, or actually there will be a surge in buying more trucks if volume picks up. So, like I mentioned, fuel, it's another factor that we monitor, and fuel prices are at historical low levels, and the projection is that the truck net rates get impacted by fuel prices and will be flat as the oil prices remain low. Finally, we come to how was 2017. I think it was a pretty good year for domestic container volume, 2.3% growth for the first 6 months, and we expect 2017 to close at 2.5, so not too far from what we see right now. Trailer, on the other hand, has been having a couple of difficult 2 years in the past. This year, surprisingly, trailer volume is at 2.4% for the first half compared to last year. We're expecting trailer volumes to be at 1.7% growth for the entire year. And the growth of trailers is mainly driven by 28-foot trailers, or we call them pups. This is my next slide where it shows that they're about 13.2% above last year, and 53-foot trailers also about 1.9% above last year. 45 and 48-foot trailers continue to exit the market, and these two types are drawing the volume down. So I think the also increase in volume in the trailer business is another indicator that trucking capacity is starting to get tight that will eventually benefit the domestic container segment. And I think we are finishing ahead of time. That's all I had for domestic containers. Hal, Peter?
That's great. Thanks, guys. That's really fascinating. Some interesting trends going on there, too. We're going to go ahead and open it up for questions to the attendees. We've got a few that have come in already. One goes back to just sort of a definition geography question. You guys were talking about the all-water share. And from your perspective, what do you consider the Mid-Atlantic?
That would be Norfolk, I believe.
Okay.
Yeah, because Charleston still considers South Atlantic.
Northeast is New York. Mid-Atlantic would be Norfolk. I think what's mixed in there, Norfolk, they're probably Baltimore. It isn't just one port, but Norfolk is the largest port. Northeast is New York, but there's also Boston, things like that.
Yep. Okay. Thank you. Here's another one. Do you see, you talked about transloading a good bit. There's some really interesting stuff happening there. And I think it was your perspective on that is helpful, because I know it was a little bit elusive when it started to kind of bubble up in the numbers last year. Do you see any evidence of transloading on the East Coast?
We do, and that could partially explain this gap that we were talking about, where imports grew 6.3, but rail was only 5.5. If there's transloading in the East Coast, that 5.5 total rail could be higher, could be closer to the 6.3. It's been hard for us to get at the data because, again, nobody reports it, but I think there's probably a reasonable amount of transloading in the Norfolk area. There's probably some in eastern Pennsylvania, Chambersburg, Harrisburg area, maybe a little around Atlanta, and some in Savannah as well. So maybe 10% of import TEUs into the eastern, not excluding the Gulf and Florida, places like that, but the real eastern seaboard, maybe as much as 10% of the import TEUs that discharge there might transload and move inland by rail. Probably the bottom would be 4 or 5%, and the top might be 11 or 12. If I had to guess, I'd peg it close to 10.
Interesting. Here's another one. What is the impact of the recently expanded Panama Canal on international intermodal, do you think?
That's an interesting question. When I think of the Panama Canal, I don't think it's had much of an impact. And then if there's anybody from the Panama Canal listening, they'll probably put a hit on me here. But I think there's just been a steady rise in all-water share, regardless of the size of the vessel that could go through the Panama Canal. Among other things, you could bring very large ships through the Suez Canal, and the sailing time was maybe 1 or 2 days more than if you could bring that same vessel through the Panama Canal. So cost-wise, you always had the ability to bring a large ship to the East Coast. And after the recession, a lot of steamship lines started to do just that. And then once the Panama Canal completed, those large ships reverted through the canal again, but it's really no more freight. It's just taking a different route, and now they're going through the Panama Canal instead of the Suez Canal. So I think what's driving all-water service is really owners of the cargo wanting to have more locations to bring their freight, either as a hedge against labor disruption or simply to have distribution in various locations to help them move freight around. Sometimes it's called the four-corner strategy, to have a distribution center in the Pacific Northwest, in the Southeast, in the Pacific, I'd say PNW, PSW, Southeast, Northeast, maybe a fifth one might be the Gulf. So you have freight in a bunch of different locations, and then you can have distribution through different channels to get to the same place. So you could serve Chicago through Seattle, LA, or Savannah if you wanted. And I think that's been a key driver, and it has nothing to do with the size of the vessels or the Panama Canal. Likewise, I think we've talked about this low fuel and how it makes trucks very competitive with rail. I think low bunker fuel makes all water rates very effective and very competitive with IPI and transload rates off the U.S. West Coast as well.
Here's a question. So we're hearing that peak season has already started on the West Coast. So that's the supposition. So if peak season has started, will it be truly recognized as such and sustained, or is it a manufactured season?
I don't think it's manufactured. I mean, from what we've heard from folks lately, they think it's going to be a true and real peak. At least the international peak historically has been in August, and we got some pretty strong numbers in July that we just talked about on the call. We haven't seen the August numbers yet, but it feels like it could be a pretty good peak. I don't think it's manufactured, and I think there are probably three peaks. There's an international intermodal peak, a domestic peak, and then the trailer peak. So the international peak would be about now, although sometimes October can be a very strong month for international as well. And then we'll start to see the domestic peak in September, but really probably hit its maximum in October, and with the trailer peak coming along in November and early December. From what we hear, it feels good. I'd say dial back in our next webinar in 6 months, and we'll know how strong the peak was.
Yeah, good point. We've got a few questions around, speaking of that last of the three phases of the peak you were just discussing around trailers. Are folks tracking the orders for 53-foot intermodal trailers and containers?
I believe there's different agencies that are doing, in fact, tracking the orders, and I think it's just like no secret, like there's publications that actually are showing the sales on a quarterly basis that show not only Class 8 orders, which is the tractors for domestic and service, but also the actual sales of both finished, new and used tractors. So yes, I think there are folks out there tracking this.
Okay. Here's another one related to the trailer numbers that you were talking about. What do you think the impact of e-commerce has played on the trailer intermodal volumes?
Well, I think the e-commerce, not necessarily just the trailer, but intermodal overall. I think the e-commerce has affected the way that what they call it, like the last mile delivery, or just the actual sorting of goods when they come into the country. Not necessarily trailer, but it's affected up to some extent. I don't think we have percentages of how much e-commerce is affecting intermodal, but
I mean, we've tried to study it, and I think our conclusion is that the last mile doesn't move intermodal anyway.
Correct.
So we don't think there's been a huge impact. Something will come into the imported good comes into a coast. It has an equal chance of moving rail inland to a distribution center, whether it's transloaded or IPI, if that distribution center is controlled by a brick and mortar retailer or a internet retailer. And we don't have hard data for that, so don't run out and quote me on that per se, but the way we look at the numbers when we talk to people, we get the sense that there's not it doesn't necessarily mean it was going rail in the first place. It could go get trucked to the internet retailer's location. It tends to move rail the same as it's always been. Seems like, say, pretty good growth this year.
And another good example is the fact that there's more warehouses and distribution centers opening on the East Coast. So when you're opening on the East Coast, then we go back to what Peter was explaining on the all water share. Transloading on the East Coast is not as big as in the West Coast. So they might not necessarily move rail. They're already probably moving by truck because distances are shorter into Eastern distribution centers. So,
yeah. And then one last point on that, I think that this bad horror movie, The Divergent, that I was talking about, we tried to see if somehow that was related to e-commerce. And as best as we could tell, we could not find any evidence that e-commerce was causing the divergence. And again, this year the divergence is pretty much gone away, or it's been reduced, and e-commerce hasn't gone away, or it hasn't increased 30%. So it doesn't seem to be a lot of correlation between e-commerce and the divergence. Although maybe you could order the bad movie, The Divergence, through an e-commerce distributor. I don't know.
Chances are good that it would likely be where it would come from, I would imagine.
And hopefully it'll go intermodal to get to you.
Absolutely. Here's a question that's related to the Hanjin implosion, and I think probably by reference what's happened, in the year after that with Alliance rejuggling and some consolidation and terminal ownership questions. Do you think those things are also having an effect on IPI? You were stunned by that question.
Well, you'd think I'd be prepared for it because it's nothing new, right? I mean, Hanjin imploded about a year ago. Again, I don't think the Hanjin implosion caused a divergence. The divergence started to occur long before Hanjin imploded, and that really didn't change the numbers. I think from what I hear, the alliances, we're still getting the data to see what size ships are scheduled at which terminals. My sense is that it hasn't really had a whole lot of impact on that. I don't think the improvement in IPI has resulted from the alliances, and I don't think the deterioration that we saw last year resulted from the chaos that was caused by Hanjin. I think there are other factors involved. I mean, the freight eventually needed to move. Hanjin was certainly big. I think they were about 8% of the volume, but eventually that got unloaded and it got sent to where it needed to go.
Here's a question that someone's obviously interested in real estate and infrastructure. They're wondering if it seems like maybe a growth trend starting in transloading on the East Coast, if we might see an expansion of intermodal terminals and logistics cluster parks and things such as that in the future. Should we be on the lookout for that, do you think?
The train buff in me says I hope so. The economist in me says probably not. I think that if you are going to transload, a lot of the distances are going to be pretty short. Mm-hmm. So you probably won't go rail, and therefore you won't see a rail terminal. There may be a greater need for warehousing in the east, but visiting the ports, it looks like there's a lot. So I'm not sure that this is anything new. I think that it's going to expand as imports and the population grow. But I don't think it's something that's going to be rapid, like it wasn't there last year and suddenly it's there this year. I think there's always been a lot of warehousing in the port areas, and will continue to expand.
Mm-hmm. We've got a question. Fundamentally, does it seem like there is sufficient capacity in the intermodal system to be ready for what's looking like a good peak season?
I would say so. It's hard for me to answer that. We're TTX. I can't tell you how exactly the truckers are going to be or the railroads are going to be. I can tell you from our standpoint, we seem to think we're in pretty good shape for that. I think rail velocity is things are doing okay, at least how we see it. Cycle times improved 20% a year ago on the international side, and that meant that our equipment that we had back then, suddenly 20% of it became idle because things are moving a lot faster, and things haven't reverted to those old levels yet, so there's still plenty of equipment.
Makes sense.
From our perspective.
That's a good barometer. So I think that wraps up what we had. Gentlemen, I'd like to thank you for your time and the effort that you put into to preparing for today. It was really fascinating, and I think you offered a lot of really interesting food for thought for folks, and some good opportunities to take the intermodal market trends and statistics reports that, again, the members get as a member benefit, and really kind of dig into that and start looking at it in perhaps a different way. And also, if folks are particularly interested in the numbers and want to get the full data set and be able to crunch those numbers, the ETSO database is available. So if there's interest in either of those, you can contact Diana either by emailing us at info@intermodal.org or going to intermodal.org and searching on data and statistics. But we want to thank everybody for their time today, and take care.